Ever feel like the stock market is this giant, mysterious casino that only Wall Street understands? You see headlines flashing about the Dow Jones going up or the S&P 500 taking a dip. But what does it all actually mean for you and your money? Are these just fancy numbers for guys in suits, or can you actually use this information to build wealth? In this video, we're going to break down everything you need to know about stock market indices. No more confusing jargon, no more feeling lost in a sea of financial terms. We'll uncover the simple truth behind these indices and, most importantly, how they can be your secret weapon to making smarter investment decisions. By the end of this video, you'll be able to confidently navigate the stock market landscape, understand what makes these indices tick, and use that knowledge to potentially amplify your returns. So, buckle up, hit that subscribe button, and let's decode the matrix of stock market indices together. Alright, let's start with the basics. What exactly is a stock market index? Think of it like a giant, super detailed report card. But instead of grading your history class, it's grading the entire stock market, or at least a big chunk of it. Just like your report card shows how well you did across different subjects, a stock market index tracks the performance of a specific group of stocks. Let's take the S&P 500 for example. This index tracks 500 of the largest publicly traded companies in the US. Think big names like Apple, Amazon, Google, the heavy hitters. When people say the market is up today, they're often referring to indices like the S&P 500. Now here's the cool part. These indices aren't just random lists of companies. They're carefully selected to represent different sectors of the economy. So, you've got indices for tech companies, healthcare, energy, you name it. Why should you care? Because by tracking these indices, you get a bird's eye view of how different parts of the economy are performing. Are tech stocks soaring? Is the energy sector lagging behind? Indices give you that valuable insight at a glance. Here's a pro tip. Don't just look at the overall number of the index. Dive deeper. Look at the individual companies within that index. See who the winners and losers are. This will give you a much more nuanced understanding of market trends. Now that you're familiar with what a stock market index is, let's meet some of the biggest players in the game. These are the indices making headlines, influencing investment decisions, and practically dictating the mood of the financial world. First up, we've got the heavyweight champion, the S&P 500, which we already touched on. It's like the all-star team of the US stock market, representing roughly 80% of its total value. When the S&P 500 sneezes, the rest of the market catches a cold. Next, we've got the Dow Jones Industrial Average, or the Dow as it's affectionately known. This one's been around since the 1800s and tracks just 30 large, publicly traded companies. Think of it as the exclusive club of American industry. And then there's the Nasdaq Composite, the tech-heavy index. This one's home to giants like Apple, Microsoft, and Amazon. If you're into all things tech and innovation, this is the index to watch. But the US isn't the only game in town. Internationally, you've got the FTSE 100 in the UK, the DAX in Germany, and the Nikkei 225 in Japan, just to name a few. These indices give you a snapshot of how markets are performing across the globe. Here's a real-world example. Let's say the price of oil skyrockets. This would likely cause energy company stocks to surge, pushing up indices heavily weighted towards that sector. On the flip side, airlines, who rely heavily on fuel, might see their stock prices dip, impacting indices tied to travel and transportation. Pro tip: don't limit yourself to just your home country's indices. Diversifying your portfolio globally can help mitigate risk and potentially boost your returns. Alright, time to roll up our sleeves and get a little bit technical. Don't worry, I'm not going to bore you with complex equations. But it is important to understand the basics of how these indices are calculated. Remember our report card analogy? Well, just like your grades are calculated based on your performance in different subjects, stock market indices are calculated based on the prices of the stocks they track. The most common method is market cap weighting. Basically, this means that companies with a larger market capitalization, the total value of all their outstanding shares, have a bigger influence on the index. Think of it like baking a cake. The ingredients are the companies, and their market cap determines how much of each ingredient goes into the mix. So if Apple has a massive market cap, it's like the flour in our cake. It's a major component. A smaller company would be like a teaspoon of vanilla. It adds flavor, but it doesn't drastically change the overall taste. Other indices might use different weighting methods like price weighting, where the stock price itself determines its influence. The Dow Jones Industrial Average is a good example of this. Here's the key takeaway. Understanding how an index is calculated gives you insight into what's driving its movements. Is it a few heavy hitters pulling the index up, or is it a broader market trend? Pro tip: don't get too hung up on the nitty-gritty details of the calculations. Focus on understanding the general principles and how different weighting methods can impact an index's performance. Now let's talk about why all of this matters for you, the investor. Because here's the thing, stock market indices aren't just abstract numbers. They're powerful tools that can help you make smarter, more informed investment decisions. Think of indices as your roadmap to the stock market. They show you the general direction the market is heading, highlight potential investment opportunities, and help you measure the performance of your own portfolio. Let's say you're a long-term investor aiming for steady growth. You might choose to invest in an index fund that tracks the S&P 500. This way, you're essentially buying a tiny piece of all 500 companies in the index, giving you broad exposure to the market. Or maybe you're more of a risk taker and believe in the future of renewable energy. You could invest in a sector-specific index fund that focuses on clean energy companies. This allows you to capitalize on the growth potential of that particular sector. Here's a real-world example. Imagine you invested in an S&P 500 index fund 5 years ago. Over that period, the S&P 500 has delivered an average annual return of around 10%. Your investment would have grown significantly, even though you didn't pick individual stocks. Pro tip: before you hit the buy button, always do your research. Understand what the index tracks, its historical performance, and the associated fees. Alright, it's time to debunk some common myths and misconceptions about stock market indices. Because just like those pesky urban legends that refuse to die, there are a lot of half-truths and flat-out falsehoods floating around about indices. Myth number 1, the index is the market. While indices like the S&P 500 are often used as a proxy for the overall market, they don't tell the whole story. Remember, they only track a specific group of companies. There's a whole universe of smaller companies, international markets, and other asset classes that aren't reflected in these major indices. Myth number 2, if the index is up, everyone's making money. This couldn't be further from the truth. Remember our cake analogy? Some ingredients matter more than others. If a few heavy hitters in the index are doing exceptionally well, they can skew the overall performance even if other companies are struggling. Myth number 3, investing in an index fund is a guaranteed win. While index funds can be a fantastic way to build wealth over the long term, they're not without risk. The market can be volatile, and even the most diversified index fund can experience downturns. Here's the key takeaway: don't blindly follow the hype or believe everything you hear. Arm yourself with knowledge, question assumptions, and make investment decisions based on your individual goals and risk tolerance. Pro tip: if something sounds too good to be true, it probably is. Be wary of get-rich-quick schemes or anyone claiming to have a foolproof system for beating the market. So there you have it. We've demystified stock market indices, explored their inner workings, and discovered how they can be powerful tools in your investing arsenal. Remember, knowledge is power. The more you understand about these indices, the better equipped you'll be to navigate the complexities of the market and make informed decisions that align with your financial goals. What are your biggest takeaways from this video? What indices are you most interested in tracking? Let me know in the comments below. And don't forget to like this video and subscribe to the channel for more financial insights and money-making strategies.